Howdy, everybody. Welcome to Liberty Call. I am Raymond Dolman, your humble host, and today is, what day is this? Wednesday, December 4th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a gorgeous day here in Colorado. A little chillier than yesterday. I had to go out again this late morning and had another 11 o'clock appointment for this time for my nose because I've been having nosebleeds and they had cauterized them a month ago, and they wanted to check up, make sure there was nothing else they needed to do. So seems to have worked. As you can tell, I cleaned up the beard, and unfortunately, I usually do it. I'll take a shower and then dry everything, comb it and everything, and then I'll trim it and then hop back into the shower, rinse all the hair off. But today I was already dressed, so just button my button, and now I'm all itchy and gross. So anyways, all right. Well, before we hop into the markets for today, looks like at least domestically things were in a good mood. I need your help. You out there, yes, the three people watching, if you could do me a favor, give me a thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All righty, well, let's go ahead and get to the numbers. Dow Jones up 0.69%, 308 points, closed at 45,014. S&P 500 up 0.58%, 35 points, closed at 6085. Nasdaq up 1.29%, 251 points, closed at 19,732. The VIX was also up today, weird, 1.2%. It's at 1346. Canada flat, down 0.01. Brazil also flat, down 0.08. Mexico up 0.98%. Western Europe, Germany was up 1% flat. UK down 0.28. France up a third or 2/3%. The Netherlands up 0.19. Spain up 0.49. Italy up 0.75%. Switzerland down 0.47, and same with Portugal. Russian exchange is both red today. Again, MOEX down 2% even. RTSI down 0.17. And the Asian markets, the Nikkei was flat, up 0.06. Australia down 0.38. New Zealand down 0.9. Still, well, when it closed on the 3rd, it was down 0.94. In China, the Shanghai was down 0.42%. The Shenzhen component down 1.02. China A50 down 0.17. DJ Shanghai down 0.7. Hang Seng down 0.02. And the Taiwan weighted up 0.99%. Good stuff, I know. Very, very exciting. What is this on the screen? Weird. Anyways. All right. Well, let's hop over into the market recap and see what happened today. S&P 500, Nasdaq at record highs as tech racks up gains. Yeah, well, there's a Fed meeting coming up in a couple of weeks, and I think Chairman Powell spoke today, if I remember from reading through these articles. And so I think everyone's in hopes that the Fed's going to drop rates a little bit more, which, is business, friendly for business, especially the, the growth sector of the economy, of the stock market, which is where the Nasdaq and the technology sector usually falls into, because these companies don't actually make money. They just borrow money to continue to stay in business. And, if they do make profits, they then pour it back into their businesses. So they're usually pretty cash poor. So that's why having low interest rates, or having it, at, the Fed funds rate at 0 during Obama's entire administration, really helped big business. Whether or not it was good for the economy, I think we built up a lot of inflation during that time that reared its ugly head, especially when you then increase the money supply, the M2, by 40% back in 20 and 21. So anyways, well, let's hop into the news and see what happened today. The S&P 500 and Nasdaq reached record highs on Wednesday, driven by tech sector gains and optimistic remarks from Fed Reserve Chair Jerome Powell, who indicated a cautious but steady approach to rate cuts. Powell's comments. Speaking at the New York Times Dealbook Summit, Powell emphasized a cautious approach to monetary easing, suggesting the Fed is carefully seeking a, quote, neutral rate, while noting the economy's solid footing. Really, it does not feel very solid. If you ask everyday Americans, things are more expensive. They're not starving or anything, but, things are getting tight in jobs. There's layoffs. Anyways. Where was I? Importantly, he did not suggest the December rate cut is in jeopardy, bolstering market confidence. Odds of a December cut rose to 79% from 75.5% the previous day. Private payroll data released Wednesday showed slower growth in November with 146,000 jobs added, below economists' expectations of 166. This further fueled hopes for a rate cut later this month. Yeah, because the jobs numbers were 20,000 off. Really? I mean, these are not good jobs. Oh, I mean, I'm pointing at my notes here on the screen, and you can't see them because they're on my screen, not over here where you see this guy standing, on the stock exchange floor. Alrighty. Moving forward, earnings highlights. Salesforce jumped nearly 9% after beating Q3 revenue expectations and raising its annual forecast, driven by strong demand for AI-driven offerings like Agentforce. Marvel Technology gained on better than expected Q3 results and guidance. Okta rose 5% after reporting a profit and robust demand for its new products. Dollar Tree increased by 2% on strong Q3 same-store sales growth. I mean, what other stores would they be? Would they be like, take it over the Dollar General and you have like hordes of Dollar Tree employees going across the parking lot? And they storm into the Dollar General and say, "This is ours now." So anyway, I'm just making fun of, how they refer to this stuff. And lastly, Foot Locker slumped 9% after cutting its annual forecast due to weaker consumer spending. If I could stop with Foot Locker, I mean, that's where I, as a kid, Foot Locker was like, once a year in like September, mom took you, or August, took you to the mall and you went to Foot Locker and got your shoes that had to last you the year. So, I mean, not, if your foot grew, obviously couldn't do anything about that. But, I remember going to Foot Locker in, elementary and, middle school, because by high school I was pretty much shopping on my own. But, yeah, it was, I can't remember the last time I went to Foot Locker. I mean, last times I've bought shoes, tennies and things like your, stuff that you would wear out for running or weightlifting or just doing chores in the yard. I mean, I usually have gone to the Nike outlets, but after Nike went so woke, I started buying Brooks shoes. Brooks running shoes are really fantastic. They're American made. They're in Seattle, which I'm sure they got a few wokies working there. But all in all, it's a fantastic shoe. And I think I bought both of them. I've got two pair. One with snowmen on them. Those are kind of my casual summer shoes. And then I've got another pair, which are trail shoes, which those are for kicking around the house and stuff like that. So, but anyways, if you need tennies or you need some running shoes, walking shoes, whatever, Brooks are excellent. All right, jumping back in here, Bitcoin rebounds. Bitcoin climbed following news that the President-elect Trump plans to nominate pro-crypto Paul Atkins to lead the SEC, signaling potential regulatory relief for the industry. Yeah, because Geithner is just terrible. I mean, he was in bed with the guy with FTX, and everybody just kind of, maybe not in bed, but they were chummy, to say the least. So. All right, finishing up with Powell's steady stance and strong corporate earnings, markets remain buoyant. Attention now shifts to Friday's non-farm payrolls report, which could further influence rate cut expectations and market direction. All right, I've been rambling. I'm already 8 minutes in and only got through the first article. Next up, we got some data. November ISM non-manufacturing index. So let's dive into this. The U.S. services sector continued expanding in November, but at a slower pace as the ISM Services Index dropped to 52.1, its lowest level in 3 months. While still in expansion territory, the decline was weaker than even the most pessimistic forecasts. Excuse me. Sector highlights, activity and new orders. The business activity and new orders indices fell to 53.7, but remain above 50, indicating ongoing growth. Supplier deliveries. The supplier deliveries index contracted to 49.5, reflecting shorter wait times as hurricane and port strikes effects eased. And the employment index declined to 51.5 from 53, with companies increasingly freezing hiring and opting not to fill vacant positions. Inflation continues to pressure the services sector, with the prices index rising to 58.2, the highest among all categories. Tariff-related uncertainty added to concerns about future pricing dynamics. While monetary policy remains relatively tight, the recent rate cuts by the Federal Reserve raise the risk of higher inflation if money supply growth accelerates, which it probably will. And economic context. The services sector remains a bright spot for the economy, contrasting with the manufacturing sector's ongoing struggles. Vehicle sales improved, reaching an annualized rate of 16.5 million in November, up 6.7% year over year. ADP's private payroll showed a modest gain of 146,000 jobs, slightly below expectations. Non-farm payrolls set to release for Friday are anticipated to increase by over 200,000, with unemployment ticking up to 4.2%. While the services sector supports growth, inflation and hiring slowdowns pose challenges in the months ahead. All right. Let's see here. Got our next article up here from Zero Hedge, why more middle income Americans are struggling to save money. Probably because everything's more expensive. That'd be my guess, but let's read on. Middle-class Americans are finding it harder than ever to save, even as inflation cools to 2.6%. Well, prices have not gone down. That just means the growth has shrunk. It does not mean that prices have gone back in a negative trend. Let's see here. Persistent price increases in essentials like groceries, utilities, and housing, coupled with wage stagnation, have left many households stretched thin. The root cause of the crisis, inflation's legacy. While inflation peaked at 9% in 2022, driven by federal spending, according to MIT's Mark Kritzman. I didn't go to MIT, and I could have told you it's just from increasing the money supply. But hey, he went to college. Essential costs have remained high. Groceries now cost 50% more than before the pandemic. Utility bills have skyrocketed, and median home prices have hit a record $400,000 in September of 2024. Wage stagnation since January 21. Wages have risen 17.4%, lagging behind the 20% increase in prices. I'd argue it's closer to 40 or 50%. This disconnect between incomes and living costs has eroded purchasing power. The cost of living squeeze, starting with housing and utilities, families facing rents and utility bills, with some cutting back on heating or cooling to manage costs. U.S. utility debt reached $17.4 billion in August 2024, up 8% from the prior year. Necessities over luxuries. Families are foregoing dining out, vacations, and even preventative health care. For many, financial priorities have shifted to covering basic needs and tackling debt. Living paycheck to paycheck, a Bank of America study found that households across all income levels, even those earning over $150,000, are increasingly living paycheck to paycheck. Emergency savings have dwindled, with 25% of Americans having less than $1,000 in reserve. So the long-term impact, the middle class faces an unsustainable downward spiral, with many delaying education, extracurriculars, and professional development to survive as costs outpace wages. Financial stability for middle-income earners remains elusive. And if I could take a moment here, this is where probably you might want to go out and reach out to a financial planner or financial advisor. I'd probably reach out to a financial planner, wealth manager, someone who does more than just buy and sell stocks and annuities and insurance. Someone who's actually going to sit down with you and go through, your inflows and your outflows. I'd recommend starting out with downloading like Rocket Money. That's one people really have high praise about. I personally haven't done it in a number of years just because our cash flow is pretty good. But it certainly couldn't hurt as an exercise just to go through your annual spending, see where your things go, how much is going to groceries, what's going to, fuel, what's going to utilities at your house. What are the things that you spend money on that you really don't need to, like your Starbucks coffees. If you smoke cigarettes, those things are really expensive these days. That's why I use a vaporizer, because, cigarettes are expensive and they're bad for you. You really shouldn't smoke. Nicotine, me and my wife argue about the health benefits of nicotine, but from the research I've done, it certainly has some positive long-term effects as long as you don't overdo it. All right. Got one more article here. Well, and actually, let me stop before I do that. Let's bring up my chart. And right here's the Dow that we're on. I have another chart that I use. It's the Dow to gold ratio. And as we can see, if we zoom in a little bit, at the beginning of 2020, the Dow to gold ratio was around 19, meaning it took 19 ounces of gold to buy one share of the Dow, if you were buying the Dow Jones. Not that people do that, but it's the highest it ever, well, not ever, but the highest it peaked out at around about September of 2018. It took the most ounces of the the Dow was at its highest point. And so my point is, what we're looking at here is at the beginning of 20 to today, we are down about 10%, or I'm sorry, 8.5% on the Dow to gold ratio, meaning that your assets have not kept up with the price of gold. And so, I mean, if we go back here to our chart, get this off the screen. You don't need to see that. So if we go to gold, originally, when the market collapsed in 2020, gold was at about $1,550 an ounce. 2100 was a 40% increase in the price of gold, and we can see that now gold is way above that. So gold has actually done much, much better over the last 4 years. It's exceeded the inflation rate on things, but like I said, if we go back to the Dow ratio, we're actually lower now than we were at the beginning of the whole pandemic nonsense. So anyways, just some food for thought out there for you guys who are, you get people who are, things are so much more, the portfolios and everything else, unfortunately, even portfolios just haven't kept up. And especially if you're in a more, conservative or, if you're older, you're certainly not going to keep up with those indexes, which have been going through the roof. All right, one last article here. Let's see here. We had 2 people watching at one point. Wow, that was probably my daily limit. Let's see here. This one is the minimum salary needed for financial success by U.S. Generation and essentially Empower, which is a financial firm. They got an office here in the Denver area. They did a survey asking different age groups, 2,200 people, what they thought. So let's dive into this real quick. A recent survey by Empower reveals stark generational differences on how Americans define financial success. On average, respondents believe a yearly salary of $270,000 and a net worth of $6.6 million constitute financial success. Well, that is that's a big salary, and that's a large nest egg. However, perceptions vary widely by generation. Gen Z sets the bar the highest, estimating they need nearly $600,000 a year annually. My youngest son, who just got his first job out of the service, he's only making 6 of that, and a $9.5 million net worth. Boomers see success more attainable, requiring just under $100,000 salary. For context, the average U.S. salary is $63,795, and the average net worth falls significantly below Gen Z's lofty expectations. Nearly half, 47% of Americans believe they will never reach their financial goals, and only 37% consider themselves financially successful. Men, 42%, are more likely than women, 33%, to feel financially secure. Well, I think that's just, based on, men are more, what's the word? Solutions driven in their focus on things. Women are more emotionally, look at things through more of an emotional lens. So that's probably, finances is very emotional. I've been doing this almost 2 decades, and I've had some people cry sitting at conference tables and things. So that might have something to do with it. Furthermore, only half of respondents believe they are or will be better off financially than their parents. So, well, in my case, I've done a little bit better than my parents. The data highlights generational optimism gaps with younger Americans setting higher benchmarks for success. I'm actually totally behind that, set high goals. Unfortunately, most people don't save. That's the problem. They have very low time preferences, they have very high time preferences, meaning they want to spend all their money now, as opposed to having a low time preference for today, meaning I will defer gratification now, and I'll put this $100 away so it turns into $500 in 30 years. So, or whatever it is. Let's see here. The data highlights generational optimism gaps. Yeah, we covered that. Persistent gender disparities also show fewer women feeling financially secure. These findings underscore the challenges many Americans face in meeting their financial goals, and as rising costs outpace earnings for much of the population. And if we go to this chart, let me go to the bigger. You can see here that boomers, Gen X, that's where I'm at, millennials, where my oldest boy is, and then Gen Z, where the younger is. And then here's the average. So for boomers, they would need a $100,000 salary and $1 million nest egg. Those 2 numbers don't really jive together. As a financial planner, I would probably shoot for with $1 million nest egg, probably no more than about $40,000 to $50,000 a year, so that you don't cannibalize all your principal. Gen X, those of us from 65 to 80, 212,000 income. For those of us in our 50s, that's, as a household, that's certainly reasonable. $5.3 million nest egg, it's a stretch, but if you were going to turn that into income, $5 million, you could certainly, off a $5 million nest egg, generate, this sort of income. For millennials, 181,000 is what their goal income would be at 5.6 million nest egg. Again, these are very realistic. And then the the Gen Z guys, the Zoomers, 588,000 for an income and $9.5 million nest egg. Yeah, I mean, yes, you could take basically $10 million and turn it into $500,000 in income every year. You would run the risk of cannibalizing your principal and running out of money and not having growth. And then down here, this is the average. Average net worth is $1.1 million on a $64,000 salary. So, all right. So that's just some food for thought out there for you folks, and interesting how people view things. Again, you can solve all these problems just by planning ahead. And, that's where someone, I don't know, like me, who could help you out. So feel free, give me a call. So since we are at the end of the show, if you do need help from me, where do you go? DSAFinancialGroup.com, right there. All your financial planning needs can be addressed by a handsome, bearded gentleman like myself. All right. Well, that's everything that I had for today. I hope everybody has a wonderful evening. I'm sorry I went over 20 minutes. I usually try to keep this under 15, but we had good stuff to talk about today, right? Shake your heads up and down. Give me a thumbs up if you think so, because there is someone watching. I can see you up here on my screen. There's someone on Facebook watching, so give me a thumbs up. Have a great evening, everybody, and I'll talk to everyone next time. Adios.